The Hedgeless Horseman here, it's February the 19th, 2024. First of all, thanks to the sponsors. I think the markets are closed. I know the Canadian market is closed. The US, I'm not 100% sure if it's closed. But it's, some kind of holiday in Canada at least. Metals or silver is down. I don't know where it counts 2% from, but did it close at $23.5? Maybe it actually did close that high on Friday. I think that what was I gonna say? I think that China is still on holiday, if I'm not mistaken, and also it's like, I mean, where you would expect perhaps some shenanigans would be like China is on holiday in Canada and all of that, and you know, I mean, I don't think there's a lot of liquidity out there. So if you want to create some volatility, probably makes sense to maybe sell some silver today. And of course, as almost per the rule, if it's up one day, it's down the next. If it's down today, I think silver might go up tomorrow. Hence why it's like daily fluctuations pretty much meaningless, feels like a coin toss. So if you use that, if you if you were even able to, if you sold today your silver juniors because 2% means you think it's gonna go next 10%, go down 10% in the next week, you're gonna sell. If it turns around tomorrow, you're gonna think that, this is the bottom, it's gonna turn up 10%. So you're gonna buy, and that's basically, I mean, zigzagging is, I think, the worst thing for investors, because volatility is actually something that by far most people get abused by and not use. And that's why I think trading is so hard, especially in silver, for example. But yeah, so a holiday. First off, I think this is a very good video done by Mining Stock Education. I think his name is Bill Powers, if I'm not mistaken, and I think there's a lot of. I've watched half of it so far. I always want to try to pick up what other people are doing, and especially if it makes sense. I think he has some really good tips in this. And that's also just the fact, or it comes back to the facts, like you gotta, let's say, to earn, earn more, if that makes sense. Like, do more work than anybody else, and you would earn having better returns than anybody else. Now, especially in this market right now, in this sector right now, almost regardless of metal, the juniors are extremely depressed, and even a change in 20% change in price might mean that, hey, this stock, which will be around, let's say, in the next 1 or 2 years, that 20% discount might mean 50% or more upside in the future, depending on where the prices are going to go, obviously. But it's like the price changes at extreme lows, they go absolutely ballistic in terms of changes in future expected returns. And of course, that means also that we need a lot lower hit rate, because the cheaper you buy something, more potential upside if it actually works out. The same goes why it's like, a lot of people likes warrants, which I'll come to soon, because it adds more upside, but no additional downside risk. So that's just free additional upside, which means you need even less of a hit rate to actually even it out. That one success will pay for even more failures. So I would recommend watching this. I think it's got a lot of tips, especially in how to kind of simplify stuff, and some stuff to think about. This one, well, I'm actually going to start with this one. This is from the VRIC with Rick Rule. This is also one I implore you to watch. sounds like. I mean, I think Rick Rule has some of the. I mean, if there's one person that basically encapsulates good investing theory with the commodity sector, I think it's Rick Rule. Almost everything he says is like, I mean, basically a gold mine. He has a lot of concepts. He spits out a lot of common sense, and he's very rich, and it all makes sense. But like, how many actually follow what he does? Not many. At the end of the day, we do what we, let's say, feel like doing. And even if he, I bet when he was pounding the table on uranium a few years ago, not many people might have listened. Otherwise, the stocks wouldn't be that cheap, because they were not pricing in today. Because if they were, they would be priced higher already. I mean, if the market was pricing in that the uranium price was going to turn within the next few years, and some of these stocks were going to go up hundreds of percent as a result, they would be priced higher, because it's an abnormal result to get several hundred of percent in let's say 2-3 years. But that happens all the time in the commodity sector, because at the lows nobody thinks there's a chance they will even go up. And what's even funnier, most of us have very short time horizons, and I mean, when Rick Rule speaks, he considers 2 to 3 years kind of a short term, which is kind of fun, because if you listen to the average investor in this junior space, 1 year is already an eternity. Short term is like 3 months, 3 to 6 months. If something hasn't worked out by then it's like everyone feels stupid, yada yada yada. But listen to this.
Names like that. The idea that I can get the benefit of $400 million sunk expenditure, where I think the deposit is probably worth $1.5 billion, and the market cap is $200 million, is just, how do I say it? At 70 at least, the most fun one can have with one clothes on. This is just a superb set of circumstances. How to do this? Well, for most of my life, I've wanted to be involved in private placement, so I got a warrant where I doubled my upside with no increase in my downside. Today, I don't necessarily need to do that. There's lots of on-market opportunities and exploration. But for the purposes of this audience, I don't want to talk about the last category. I don't want to talk about the $200 million advanced exploration plays. I want to talk about the front end. I want to talk about the sub-$10 million market cap. This is as unloved an asset class as I have ever seen in my life, which means perversely I love it. You are not going to be able to get immediate gratification. You're going to buy one of these penny dreadfuls for 20 cents, and you're going to be rewarded for your intelligence by seeing it fall to 15. That's what's going to happen. And you have to have the courage of your convictions in a way that it will allow you to handle the volatility, to handle the lack of intellectual affirmation that comes from a increasing share price. But if you do it, at least if your history is as lucky as mine has been, you'll be rewarded. I need to say, for those of you who are present, that statistically, almost all exploration efforts end in failure. So don't do this if you aren't willing to accept a lot of 25% losses, looking for 1,500% gains. But the simple arithmetic is one 15-bagger with a full warrant, which becomes a 25-bagger, amortizes a shitload of 25% losses. That's the way it works. Buffett once said, you shouldn't buy a share of a company if you wouldn't be delighted to see it fall 30% the month after you bought it, so that you could apply the same intellectual capital and buy more stock. Now, sadly, I've tested that thesis dozens of times in my career, but it ends up being very true. At any rate, ladies and gentlemen, I hope that I have reintroduced a topic to you that used to be a wonderful subject of discussion in Vancouver, and a topic, too, that will make people, hopefully myself included, literally hundreds of millions of dollars here in Vancouver over the next 5 years. I'm delighted to be re-embarking on this journey, and I hope.
So, I mean, he brings up a lot of good stuff as per usual. One thing to note, like what he says, that he's mostly a finance guy. He, gets in a private placements, gets the warrant upside, which obviously skews the risk reward immensely. Which I've again just said basically that if you get even more out of the few successes, that's gonna amortize, like he put it, a shit ton of other failures, and the failure is the norm, especially in the exploration business. That's one thing that everybody seems to forget, that this is not a low risk, high reward sector. It's a high risk, high reward sector. If 50% of my exploration bets would pay off, I would get immensely rich in a quick hurry. That's not how it works, unfortunately. So you have to have a few ones that really pay off, and you have to ride them, let's say, long enough for them to pay off the other high risk, high reward stocks. But as he also points out, that there are so many advanced companies out there. They're so cheap right now relative to sunk cost, relative to what they have proven up, because you can obviously spend a lot of sunk costs without proving up anything that's worth anything. Then the sunk costs are kind of meaningless. Like one example I would say is like I-80 Gold. They have probably 1.5 to $2 billion in sunk costs in Nevada, but they also have really, really good looking deposits. I think their market cap is like 500 million right now, and it's at an all-time low from when they started trading like 3 years ago, and they've only been trading in a bear market. They have debt as well, though. I think they have like 150 million in debt, so it's not like a risk-free option on, let's say, 12 million ounces of gold plus, and even I think they have like 150 million ounces of silver or something. I don't know if that includes all the base metals from the CRD project, but that is the standout one that I can come up with, like Nevada, tier 1 jurisdiction, like literally tier 1, huge amount of sunk costs. I think there are 4 significant projects. They're even diversified with having silver and base metals, as well as a lot of gold. Do you need a warrant for that to make sense? I don't think so. And that's kind of his line of thinking, that this sector is so cheap right now that you don't even really need to play the warrant game. So what he's saying is like now, perhaps more than ever, has it been more favorable to the outsiders, to the ones who can't get a warrant. And that's not to say that obviously you would make even more with warrants, just that it's so cheap that the beach ball has been pushed so far underwater that even some of the more low risk opportunities without warrants has a very good, or can pay off bigly. And that I think is really great. I mean, I participate in private placements when I can, but just to hear that, and obviously he's pounding the table. I mean, like he says, this is the cheapest he has seen in his lifetime, and he's even going down the risk curve, getting into minus or sub 10 million market cappers, which I assume gives him warrants though. So that's something to keep in mind. And also one thing he says, that because he's not saying this is the bottom, and he's pointing out there's like, you should assume that even if you buy cheap, you're gonna be sitting at a loss. So I think that's a great mental model, or like simulate that. It's like, if you buy a stock and you assume already that it's gonna go lower before it goes higher, then it's not gonna come as a shock, because you've already simulated that future in your head. So it's again it's not gonna rally you in the same way. If you believe that's like, okay, either you're too early or too late. If you're too early, that means you're gonna have a loss before you have a profit. And of course, it's not fun to hear that when now it's like, well, some of these juniors are like down 70 to 90%, and still you have to cope with like, okay, even if I buy these, even after they've already gone down 80%, I should still count on sitting at a loss. It's not fun, but that's simply the reality. The only time you won't be sitting at a loss if you buy low is if you buy the bottom tick. The very day, the very minute a stock sees a multi-year bottom, and there's nobody on earth, obviously. There's like one guy who might be the one, you know, putting in the bottom tick. You don't want to be the guy selling the bottom tick. You can't afford to sell that low. But if you get even close to, that's what he's saying. It's like if you even get close to a bottom, those buys can be very profitable. Obviously, like he says, 25. I mean, we can see juniors go down 25. We can see juniors go down 25% right now on good news even. So, I mean, the 2 to 30%, like you should be able to stomach that. I mean, you should probably be able to stomach a lot more than that. But it's still, the principle still applies. It's like, assume you will be at a loss. And what he's saying, that's perfectly fine. There's nothing wrong with that. But as he points out, and as Buffett has pointed out, it's like, if you buy something and you actually feel like, okay, you took a position in some company, and then it's like, hey, if this company goes lower, I'm going to buy even more. I mean, then you have conviction. The worst thing is when you buy and it's like it goes lower, and all of a sudden you get nervous, which I guess happens a lot. And that's kind of a signal that you don't really know what you bought or why you bought it. That's a signal that you don't really have conviction. Either you can solve it by more due diligence or just remind yourself of why you bought in the first place, something like that. Because in my experience, I need to keep a case fresh in mind. Just go over the case. Like, okay, why do I like this? Okay, let's say a stock has gone down for like 1 to 2 years. It's like, okay, why did I think this was a good stock? Right. I mean, has anything changed? Has the case really gone south, or is this just, it's followed the market down? So it's just that. It's just that there's more sellers than buyers, not even company specific. And that might be the case. I mean, we have no idea. We might be in profit sooner, or one day on buys we did 1 to 2 years ago that are now down 50 to 70%. But obviously the buys now in the same company, assuming the case is intact and it's 50 to 70% cheaper, the expected payoff on those are gonna be way higher than the ones you purchased 1 to 2 years ago, even though they might end up in a certain time frame, they might end up in a profit. And note also that he says over the next 5 years. That's what I'm talking about. He didn't buy stock X today, and it's like, if he's not up on that stock, especially up a lot tomorrow, he's not sitting there, it's like, oh, I guess I made a mistake. No, he thinks that from these levels in this sector, in the junior sector, within 5 years, he's going to be up a lot. That's what he's saying. That's I think the biggest thing, and I've seen some good quotes on that. And I think actually Rick Rule had a quote on that. It's like, the market doesn't care about your time frame. You want the returns to happen soon. That's why people typically buy. That's why we buy tops, because we think that in the immediate time frame this is going to continue to go higher, and that's why we don't buy bottoms, because we think in the immediate future they're going to go lower. Every single low people don't buy because they think it's going to go lower, and every single high, and I'm talking ultimate low and ultimate high, nobody's buying or selling because they think they're either going to continue to go up or continue to go down. There's no person who's going to be sitting there, almost no person, who's going to see the low. It's like, let's say a crash day, and it's like, yes, this is literally the low. No, anything can go down. As long as something is above zero, it can still go down. But something that is cheap and already a buy can also go down 50%. So it's like, he's not saying today is the bottom or when this was aired. He's saying that the bottom is around here somewhere because this sector is the cheapest he's ever seen. And that means that sooner or later, they're going to go up a lot. And he gives himself 5 years to make a big return. And before people like, up to 5 years. Obviously, I think he said in another video he expects it to happen this year, that the turn will be this year. But think about it, the market average is 8 to 9%. If you're down 50%, you need 100% to go to neutral territory. From these extremes, this sector never just goes up 100%. It might go up 100% in the first week or month, or of a possibly multi-month or multi-year rally. I mean, the bull legs over the last, since 2015, saw many juniors go up 3 to 1,000%. That's just the bull legs. That's not even a bull market. That's, I guess, like rallies in a bear market, because as per Rick Rule, he suggests that yes, this sector has been in a bear market for 12 years. So imagine what can happen in a bull market. Let's say within the next 6 months we start a bull market in the juniors, which continues for 3 years, and maybe the first month has some juniors up 100%. Then it's 2 years and 11 months of a trending move higher. So after the first 100%, you're back to even if you're down 50%, and then it's all gravy. And that's going to beat the brakes off the average market return. The broader stock market average is 8 to 9%. I found a clip from 2016. Just a few comments here.
The truth is, if you make money by buying low and selling high, that presupposes that you bought low. Yep. You can't buy low when you have lots of competition in the market. So interestingly, the fact that the market is 83% down from 2011 makes people afraid. They should have been afraid in 2011.
Also, some common sense, hard-hitting common sense. You should be afraid when things are high. If you ever want to be able to make money by buying low, selling high, you need to be buying low to start off with. And nobody's doing that now. There's no volume in the juniors. Nobody's buying low. That's why almost nobody ends up making money. It's pretty simple. And it's like what he said here. This was after the crash down from 2011-12 when stocks were down 83%. Not too long after this, the gold miners had the best quarterly rally they've ever had. Not too long after this interview, my portfolio bottomed and went up 500% over the next 8 months. That's how quickly things can change. And it doesn't matter if, or I should put it like this, the curse and the cure is basically the same. So let's say you're down a lot in juniors. You had a junior portfolio, you're down a lot. You bought the 2020 high, okay. So you're down a lot. To you, that's your big problem, that your portfolio is down a lot. Okay, how do you remedy that? Obviously you remedy that by, I should find the sector with the highest possible future expected returns from where it's at. Nvidia can go up maybe 100% more. I don't know. Maybe it becomes the most valuable company in the world. That could happen. But it's not where the big gains are going to be, unless Nvidia is going to control the entire world. The big future gains is in the worst sectors right now. That's why he talks about, he's perversely, to quote himself, or to quote Rick Rule, perversely attracted to the junior space right now, because they are the most beaten up he has ever seen. So we expect, basically he's saying this is probably the best opportunity for the future that he has seen in the junior sector. And that's why he's buying, because he thinks he'll make, because it's so cheap now, he's gonna make a lot of money sometime in the future. And so, I mean, what I'm doing right now, it's a low liquidity environment. It's very hard to do any kind of, turnover with large parts of your portfolio. I mean, depending on how much you have in your portfolio, obviously. But it's like, there is volatility. I see stocks down 10 to 20 or up 10 to 20% or more any given week without a single news item. So the risk reward constantly fluctuates simply because of price. Nothing changed. Gold might be up or down $20, who cares? Silver might be up or down 50 cents today, who cares? It doesn't matter. In 1, 2, 3, 4, 5 years, doesn't matter what silver was trading at today. It's relative where it's trading at that point and today. And so what I'm doing is, like, I've talked about this a lot of times before, value shuffling, and I've pretty much always done this. It's like some companies recently, let's say that, one company I sold a bit of a few weeks ago, and I thought it was cheap. I already thought it was cheap. I felt sick for selling it, but I found something else. I actually, this particular time, I actually added more into Condor. I mean, if I could go back in time, I obviously wouldn't have done that. But that's like in hindsight. Hindsight doesn't really help us. Investing is about the uncertain future. But anyway. So I sold a cheap company, a bit of shares of a cheap company, which I like. It's like, I'm very bullish on the company. I think it's super cheap. But it's like, okay, I know I'm selling something cheap, but I'm buying something that I thought could, in this case, like Condor, that I think's like, okay, if I think there's a 30 to 50% chance that the Pucamayo is as good as it looks. In that case, if it proved to be the case, if the truth machine, the drill bit, would have been, if Mother Nature would have been rewarding, I could be sitting at a big profit in Condor already. And then I could go and reinvest and buy even more of the other cheap one. And that's what it's like. It's a double-edged sword. And I talked about this. I wrote this in the Condor room. That's like, it's a double-edged sword because alpha right now is greedy. Like Rick Rule said, in a sense, that's like, you can buy advanced de-risked stuff with a lot of sunk costs that are trading for fractions of what those projects are worth and probably going to trade at one day, without warrants, without taking any, I mean, he didn't go on to risk, but it's like, without taking any if risk. Now, as this cheaper is going extremely cheap, it's the beta plays that are going up most in risk reward, simply because they have margin of safety. If you have 3 million ounces in wherever almost, and it's trading for 30, 40 million, we know what that trades at highs or even mega highs, a lot more. And they don't even need to lift a finger to make sure that they have gold or silver or whatever. No, they already have it. So then it's up to, okay, if they can just stick around and not diluted by hundreds of percent, you're probably going to end up making money in that. That's not something you can say with the alpha plays like drill plays. You can possibly make this is a very hard market to make much in even exploration stock, but it's like, if there's just take Snowline, that's one of few that's actually gone up a lot over the last 3 years when the market overall is, the median junior is down 80%. That's actually up 1,000% or something. So there are occasions where that can happen, even though it's getting harder and harder. And that's also showing it's getting more and more unfavorable for pure alpha plays, because even if you're kind of successful, you don't get rewarded for it. you will have much dilution, and maybe there still won't be much money to, like, okay, let's say they make some kind of a discovery hold, but there's no money to really follow it up. Then it's hard for them to prove that they actually, found something of significance, obviously. So the risk reward is very unfavorable. But with that said, some stuff is simply really, really cheap. And yes, the market doesn't care right now, but if someone hits something, that could still end up working out. But back to my point about value shuffling. So it's like, I might, let's say, I own A and B, and when I was going to say bored, but let's say A and B were trading equally. I thought they were equally cheap. I had the same portfolio size. Let's say I have 2% of my portfolio in both. No news for either one. They're in the same business, all that. Let's say both are gold juniors. And 1 week B goes down, whatever. On no news, again, nothing has changed for the company because it's only been a week, no news, yada, yada, yada. Then sometimes I'm tempted to, like, okay, I'll sell a bit of A, buy a bit more of B, because my future expected returns from this went up. So yes, I take a paper loss on that week in B from the week before, but I sell some of A, buy a bit more of B. So again, at face value, at the time, nothing appears to have changed for my portfolio because I still am down. Because if I had equal amounts, etc., I'm taking a paper loss. If these were the only two stocks I owned, my portfolio would be down, whatever. Let's say 10%, because it's like, down 20% on a 50% position. So I have, let's say I start out with $10,000. I have 9,000 left, let's say. What am I talking about? Jesus, sometimes my math sucks. Well, basically that's it. Okay. So you're down 1,000. Your $5,000 position went down 20%, so you have 4,000. So you're totally 9,000. So your portfolio is down 10%. But then you sell some of A to buy a bit more of B. Again, not that you predicted it would fall, not that you think that A is not cheap or even close to expensive. You think you're gonna be just fine to do absolutely nothing because you think both are cheap. Still, if you expect a dollar invested in B after the fall will net you 101% on average instead of 83, that's still 17% extra future returns on any dollar you spent buying B instead of A after this 20% drop. So again, nothing changes. Your portfolio will look a bit different. Maybe you're up to 60% in B, 40% left in A, but your portfolio at the time, because you sold something, bought something else after the fall, so you still have $9,000 after you have reshuffled. So nothing on the surface appears to have happened with your portfolio. You didn't avoid any losses, nothing like that. You don't look smart at all because you're down. In the future, though, if it's obviously better than if they were trading here and both your $10,000 portfolio is gonna return 83% over the next few years. Instead, you reshuffled, so your $9,000 portfolio is gonna have 60%, let's say, in something that's gonna return 103% from the week after, and you have 40% that's still gonna return 83. So you're juicing up your future expected returns by using volatility in your favor. Even though at the time, that's why it's like investing is all about the future, And that's why in case for, let's say, Condor, the double-edged sword with like Condor, if you take a big exploration hit like that, is, well, if they would have been a success and you can reinvest that in let's say, lower risk, dirt cheap companies or really cheap companies, the compounding effects are just monstrous. If you get, let's say, 200% extra dry powder from one case working out, and that's like in short order. If it would, it could, have gone up 1,000% later if, it's another P-arena. But the point is, you would be ramping up your ammo because you have an alpha play that worked out, which is a rarity in these times. And you can reinvest it in stuff which like, probably 200-300% easily spread across, 10 different companies where you think the average return is going to be 200-300%. The compounding implications are just enormous. Instead, when you take an alpha hit, where it's like, because Condor doesn't have any margin of safety. Still, they have a lot of exploration potential, but no margin of safety. Unlike, if you have something proven up with like 2-3 million ounces of gold, that's going to go up just if gold goes up. If Condor misses on all their targets, they might be drilling, let's say, this year, there won't be that much to revalue from, right? But still, if they, make it work in a hot environment, of course, you could have a success out of that. But the point is that that's where the double-edged sword is. Lower compounding. But at the same time, we go back to the fact, okay, let's say you have losses. Let's say your portfolio is down 50 to 70%, whatever, over the last 3 years. The best place to find high future returns to offset your, let's say, poor past performance is to find the cheapest sector. So we're already in the cheapest sector. So the good thing that, let's say you were, you had bet heavily on, let's say you only had 2 exploration stories and you put all your money up here in 2 exploration stories. Okay, like nosebleed risk on. And they fail up here. And you're down, let's say, 50% in your portfolio. And all you know is about mining, let's say. That would really be, especially if you kind of started out here, not that you already have like 300-400% gains and then get cut by 50%. But still, the fact remains. What's the remedy? How easy is it if you're down 50% up here from exploration risk to find something that's gonna easily climb back 100% and might go a lot higher over the next few years? There's not many juniors here, because here a lot of them, well, most of the juniors don't work out anyway, but the sector overall was much higher priced, possibly even, a lot of cases probably overvalued, given again that most juniors won't work out. They were pricing, almost every company junior up here was probably pricing in a fair shot of actually ending up with having something substantial, or had something substantial. So then it's a much tougher. It's like if you took a big risk and took a big hit up here, there's no easy future returns from here. And as we know now, the next 3 years would have the median junior down 80%. So there's no easy, let's say, fix to that. When you take a hit down here, at least there's like opportunities spilling all over the table. So where in the very sector that, let's say, you took a hit, it's also the sector where the highest future returns are going to come from. And that's, again, still goes back to the compounding thing, that if you have a major alpha hit and are able to increase your shareholdings at lows, that's going to superduce an already superduced expected future return. If you take a hit, you probably won't have that of a hard time at least getting back what you lost, but it won't be compounding. It's like, yes, let's say you're down 50%, and you're gonna get 200-300% over the next few years. Obviously, you're gonna be you're gonna have a good return, very very good return. But if you're up 50% down here and then have 200-300%, I mean, it's like night and day if you compound what those portfolios are going to be worth in the next 2-3 years. So again, it's a live by the sword, die by the sword situation, where it's like if you're successful in some alpha plays at lows, you can really have some monstrous compounding in the future. But the best risk reward is still beta plays. That's what I talked about on K Report recently and posted on Twitter. It's like it is still, even though I'm mostly in alpha plays, it's still beta is going up. And I remember I talked about that near the lows here as well, and I was pretty much all in beta in the 2015-16 bottom. But that also, like I've shown before, my portfolio went down. I started, I don't know, investing around here. My portfolio went down actually 54% before the turn. And we don't know when the turn is going to come. But obviously I look like the worst investor in the history of the world if I'm down 54% in 4 months. And if you zoom out, that looked pretty friggin' low, right? But as per Rick Rule's comment, you should, even if you're buying cheap, dirt cheap, cheapest in 20 years or 30 years, expect that you're still gonna be down before you're up. Because the only single point in time you're not gonna see a loss first is just this here. And you can, zoom into like not only days, but like hourly. There's like one person that makes one buy that's not in a loss first. Otherwise, you're always going to be in a loss. So you're either too early or too late. If you're too early, you're probably going to make a lot more money than the ones that are too late. But you have the price is that you're going to look dumb before you look smart. You're going to take some heavy losses, potentially heavy losses. Again, minus 54% in 4 months, that's a heavy loss. And I think some people are complaining that they're down 40%. Or 45 in the last 3 years. Some are probably down a lot more. Still, if you're down 45% from this top to here, you're outperforming the median junior by a mile. The median junior is down like 70-80%. So if you're down just, I think 50% is going to be that's going to be a cakewalk. Let's see here. Back here, when were you up? It's like, okay, biggest portfolio loss down here. Already here, in what's that? In a month, in a month you're already back to even. And of course, what's even better if you're down a lot, if you're down 60% or 70%, if you buy more, maybe you reduce that to minus 50%, just from, again, buying even cheaper than you started off buying. Then you're going to be in the, start to be in the profit after here. Otherwise, depending on how much you're down, maybe it starts here. Whatever. The point remains. It's like the best offense and defense is buying cheap. And the cheaper it gets, the more you buy. Because you're simply going to end up making more on average. And what Rick Rule talks about, and which I kind of switched to right now, well, I'm not going to say I've switched to it recently. I started actually looking at private placements back here. Putting into some juniors where it's like, okay, I probably wouldn't buy it if it wasn't for the warrants, etc. Not saying I obviously don't try to buy something that I know is like crap, but still, it is such a skew to have warrants as well. And I thought, the sector was already cheap back here, especially the higher quality juniors. I thought that, a high quality junior can basically be cheap. There's a few stocks that's been cheap at some point in time throughout this entire experience. Were there many juniors that were literally cheap up here? Doubt it. Maybe 0.1%. Down here might be 99.9%, especially if you actually count the ones that, or only counts the one that actually has a shot, are decent to better juniors. They almost no single high quality junior, regardless of market cap, is going to be expensive right now. By definition, they're going to be good buys. And even the best quality juniors were probably overvalued here. Even though, so here's like finding a needle in a haystack to find something that's actually cheap for the longer term, let's say. But there were stocks that there were acquisitions and discoveries all the way down through this. So there's still, I mean, there's always some kind of opportunity. It's just that on the way down, it's basically only alpha that can give you a shot at some returns, and that's like, again, very, very rare. I mean, look at Snowline's chart, for example. Okay, so let's say Snowline's up 1,000% in 3 years. From here to here, every single junior that was around and didn't mess up too much, let's say, or kill their story, was probably up 1,000%. So from here to here, this entire sector was Snowline. From here to here, this entire sector was at least half a Snowline. From here to here, every single stock was pretty much half a Snowline. From this period to here, there's only one Snowline. So in the big scheme of things, it's the big sentiment waves where the big money comes from. And down here, when the next big wave is up, it's beta that goes up. It's like a diversified portfolio where you make sure you're gonna get the next high. Should you be all in an alpha play down here? It's like, yeah, I mean, that's basically the most super greedy thing you can do right now. But there's a bunch of exploration stores that are still cheap. It's just that, yes, if they work out and find something substantial, they might return 2,000%. Whereas the average, decent to good beta play might have a high chance of paying out 300 to 500% over the next few years. Risk profile totally different. But if you want to make sure to make money in the next big wave, you have to make sure you're around. And in that case, make sure you have beta that can revalue, because $100 per ounce of gold in the ground, let's say that was the value up here, and now it's down to 10 or 20 or whatever. If you have 0 ounces, there's still nothing to revalue. But if you go from 0 ounces to a lot of ounces, and every ounce in the ground is getting valued at $100 up here, I think up here, even ounces in Brazil were valued at $150 per ounce. I mean, think about it. It's just crazy. I mean, there's stories out there where it's like, yeah, some company might have a discovery. If they have one, maybe they end up with 2-3 million ounces. Let's say we find ourselves in a few years up here. That's where the sentiment levels are. Nobody can even foresee a downtrend in the junior. Nobody was expecting this market to ever end up here. That's what I can tell you. Now nobody expects this sector to have ever, this bear to ever end and go up. But it's gonna do that. 100% certainty. Still, you can imagine, like, go from 0 to, let's say, 2-3 million ounces, and each ounce is valued at $150 dollars per ounce. If they start off really cheap, I mean, that could be a lot. Let's just put it like that. So it's like, okay, what have I been doing lately? It's like, again, this is crunch time. These lows, crunch time. We're in the doldrums now. I mean, I think we're somewhere around here. I didn't know that was going to happen. Another point about warrants, actually. So it's like, okay, when I started putting in some, invest in some juniors with warrants, which I would like, probably not have, bought them if it wasn't for the warrants. I mean, I have some positions that I don't even talk about because I don't think they're, let's say, great per se. It's like, no, they're not great companies or anything like that. So I'm taking that as a, trading sardine bet with warrants. And in that case, it's, I mean, I can't really say it's like, oh, I think this is a great case. No, it's like, I think that's maybe a great speculative case if you have warrants. Otherwise, if you don't get warrants in the private placement, they might not be good. I'm participating in, for example, a few silver juniors recently, and one is like, yeah, there's good people and all that. It's more of a long shot actually. Could work out really well, but it's like, I think I got 3-year warrants. So let's say I started buying private placements in companies, like not necessarily stock picking, more like bet that, oh, last time or when we were down here in 2020, it's like, this is what happened afterwards. From these levels, this is what happened afterwards. From these levels, like within 2 years, you were still up a lot. So that was the only rationale. I didn't predict that the sector would get even worse, that we would go back and have the cheapest sector since early 2000s, as per Rick Rule. So a lot of those warrants, they basically are running out now. And with the stock prices in some of them, they might be down like 70% just from when I bought. So maybe the warrant strike is up here. So it's like, there's no way I'm gonna, most of them are gonna return worthless. But I didn't obviously know. I didn't know we were here and this is what's gonna happen. We could have been here and this is what was gonna happen within 2 years. But that's just, I was gonna say, the price for paying. Now, okay, now we know we're down here. Still don't know what's exactly gonna happen in the future, but I would bet there's a higher likelihood of being up a lot from these and these even lower levels in 2 years than up here. So now I'm also getting back to like, okay, yeah, full warrant. Okay, if I get a full warrant in some stores, if they're still around, especially if I try to get into a beta silver junior placement also, but that was full actually, to my chagrin. Because the way I see it is like, I think the silver juniors are going to turn around within 3 years. And from these levels, they could go up 10x. And if you have warrants, might give you a 15x, etc. So it makes total sense. But a lot of people, I think, is like, let's say you take private placement with warrants here, 2 years expire, and then it's like, oh, there's no point in this. This sector never turns around. Now, as we know, by definition, the longer it takes, the only thing we know down here compared to here is that it's A, cheaper, and B, closer to the next upturn. That's the only thing, because we know there's 100% chance there's going to be a bull. I mean, I have been thinking about an analog for that. That's like, let's say you have a, let's say, elongated lake, and it's a very foggy day or morning, and you're in your boat, and you just start, I was going to say, step on the gas. You can't see anything. You're just heading straight over. You don't know where exactly. Let's say this lake is narrower in some areas and thicker in others, and you don't know which area you started off with. The only thing you know is that the longer you have been in the boat, just headed straight forward, without seeing you don't see anything. There's only fog. With each passing minute, it gets you closer to the turn, which would be the other side of the lake. How most people act in investing is that if you've been riding in that motorboat for like, let's say 30 minutes, and the average width of the lake is like, it takes you, 20 minutes or whatever to cross it. Okay, you're not, evidently after it is passed, like, that wasn't, you're not at the most, the average width of the lake. So it's like, here, that this wasn't the bottom, right? But what you do know is that there is a shore, And for every passing minute that you're still hitting the gas, it's like going forward without reaching it, it's getting increasingly closer, regardless of if you're even at the widest area of the lake. So the funny thing about investing is that the longer they haven't seen the shore, they're gonna start making bets and believe that there is no shore. That's the funny part. So it's like when you've been in your motorboat for almost, let's say theoretically, the limit of how long it should take, even if you're at the widest part of the lake, people think again, you're never even going to reach the shore. They get convinced that this lake is endless, it's infinite, there is no shore. So they're more likely to sell, betting that there is no shore, even though by definition, by the laws of, let's say, physics, in this case economics, we know it's gonna turn. We know there is a shore. The longer we're in the boat heading towards a shore, which we don't know exactly how long away it is, we just know for every single passing minute we're getting closer and closer to that shore, even though we can't see it. So you'd obviously, I mean, a rational person would be like, okay, we're up at, let's say, 98% of the distance that it would take for us to get to the other side of the shore, even if it's at the widest spot. I mean, you would be buying like absolutely crazy if you knew that when I arrive to the shore, I'm gonna get, or let's say you're 2 minutes away from the shore. There you're gonna get, let's say, 300%. If it's 1 minute past or 1 minute more, it's like even closer to the shore, then you're gonna get 400%. If you're half a minute until the shore, from there, if you buy, you're gonna get 400%. You would be going absolutely ballistic. The later you are in the cycle, the later you are, the longer you have been motorboating, the longer you spend time in your motorboat, because there is a shore and it's going to pay off even more, and the later you buy, the more you're going to make when you hit the shore. I mean, this is probably sound like a very weird analog. I'm trying to come up with a better one, but I hope you get the point of what I mean. It's like people forget the obvious more and more so. So, and that's also the funny, interesting part is like this here, exactly here, is the point of maximum depression, pain, hurt, nightmarish. The nightmare's never been greater. But when you reach the inflection point, which is the exact low, which nobody knows where it's gonna be, might have been here in Bear Creek's case, we don't know. Here it's like rainbows and sunshine, or this is even better, I think. So down here, point of maximum absolute despair, nobody's happy, not a single person, is also the point from where you're not gonna be in a loss in any single stock from here on out. So this is the start of nirvana and the end of the nightmare, but it's always priced by the market. I mean, if this wasn't priced in, obviously, in that case it would have stopped falling here or something. So here the sector was pricing in almost 0% chance that there was going to be a bull run in this sector within the next 5 years. Almost 0% chance. At this point in time here, there was almost 0% chance priced in that there was even going to be a correction, let alone a bear market within the next 5 years. The markets get extremely one-sided and dumb and stubborn, and they forget the obvious, that there is always a shore. There are no infinite lakes. The only thing we know, if the bottom is not already in, we're getting every single day, we're getting closer and closer. And if these juniors get cheaper, it means the higher and higher the future expected returns are going to be as well. One day, which might have already happened, we have past the point of lowest share price. And when we look back, we're going to see that, wow, if I knew back here what I know now, that it was gonna be 3 glorious years ahead, man, would I wanted to buy cheap companies, warrants, because now you can't go back in time, unfortunately. It's like, because that's what you hear all the time. It's like, oh, I wish I would have bought more. I wish I would have bought more. When it actually happens, like now, you see no volumes. Nobody's actually buying. Oh yeah, and also I would point out the fact that prices basically, especially in the low liquidity juniors, it's like a mirage. Yes, it says that, hey, you can buy this stock for whatever. But when you think about it and realize how little stock sometimes there is out there is no way that you can get in with a meaningful position at any of these prices. That's why another thing why people fool themselves that, oh, I'm just going to jump on board when it becomes obvious that we're in a bull leg. You're going to be paying up probably 100, 200% at least. And what's even worse, it might be a full fake bull. 100% in 1 month or so. 100% in 1.5, 200% in 1.5 month. Relatively quick 100%. Here was 290% in, what's that, like 2.5 months? This was like, I don't know, first 100% probably came in a month, yada yada. And this is not even the most illiquid of juniors, even though it's illiquid. But this is what I'm talking about. You don't even know which rally is real. If you're waiting to get in after people has confirmed it's a bull, up here people can kind of confirm it's a bull. Or maybe up here. Again, when did people know it was a bull or a bear? Or when were 90% of people convinced it was either or? Were you convinced this was a bull here? I doubt it. Does this look like a raging bull? It's down this much and it's only up back up here? No. When were you convinced it's a bull? Well, it made a higher high. Well, congratulations. You bought here. Up here, everybody can see it's a bull. It's beyond obvious it's a bull. That was also the absolute worst time to buy. Down here, anybody and their mother can see this is a bear market. Best time to buy. Anybody and their grandmother could see this was a bear. Plus it broke again. It's like you see this stuff all the time, especially in this sector. Break even lower, panic selling, even though you have to be brain dead to sell that cheap. Boom. Okay. Slight outbreak breakout. You gotta be, let's say, brain dead to buy this because it's so overvalued. Boom. And here, up here, there was 0% chance priced in that this was gonna happen. It's just remarkable how the sector that's been cyclical forever, everybody forgets it's cyclical. It's like Rick Rule said in a recent interview. Everybody has now forgotten that juniors can go up. That's what I'm talking about. People think that, again, going back to the boat analogy, the longer they haven't seen the shore, which by definition means it's getting closer and closer, they start to believe there is no shore and start to bet accordingly. It's absolutely crazy. I mean, there's maybe better analogs. I mean, you run with a blindfold. You don't know how long the track is, but you know it can be all the way from 0 up to 100 meters. Somebody tells you, it's like, oh, it ran for 98 meters already. And still you would like, no, I believe it's endless now because I haven't seen it I haven't seen the finish line for the first 98 meters, so that means there is no finish line. So I'm going to sell everything because I don't think I'm ever going to, reach the goal line. And you're betting accordingly that there is no finish line, goal line. That's the stupid shit we do. So Rick Rule is down here right now pounding the table. There's like, give this a few years, you're probably gonna make a lot of money. And if you're down a lot of money, what better place to be than in a sector that can give you a lot of money in the future? And yeah, I mean, First Majestic also is like, I would consider it more of a, again, trading sardine. It's like when it turns, and nobody knows when it turns. That's the thing. Nobody knows when it turns. Why wasn't this the start of this? Well, we know it wasn't. Why wasn't this same level went up here? A lot of people probably bought it because they thought, well, this looks like the start, well, the beginning phase of this bull leg. You buy because people buy because they think there's imminent rewards. They sell because they don't think there's imminent rewards. So every rally is going to be doubted. And now, as you can see, I mean, it's not just for Bear Creek, but it's basically dead. That's a few. And let's go back to, no, I don't have that. Oh, I thought I put it up. Maybe not. But here are a few examples, like how quickly. Okay, you think, I don't know what it was trading at before. Let's say, what was that? Like 9 cents, gold basin, for example. Oh, you see 9 cents. It's like, oh, okay, gold basin for 9 cents. But it's like, is it really 9 cents? 43,000 shares had that up for almost 40%. So when you're out there looking at some of these dirt cheap juniors and you're thinking, well, I'm gonna get in later when it's, when I know we're in a bull leg or something, or there's no rush. I mean, I can buy it now at 9 cents or whatever, and I have a bunch of juniors I can buy at 9 cents. Let's say you think they're cheap, and it's like, no rush. No, these opportunities can be gone in like a day when things really get going. You have no idea. Imagine if you would want to take a big position in gold basin, you were looking at it at 9, it's like, no rush. It's like, okay, 43,000 shares. And that's only what? 43,000 shares, let's say, excuse me, it's like $4,730, let's say, on average price paid, 40%. One day that this is going to be the low. We might not see levels like these in some of the juniors in the next 8 years. So now I would say it's the time to have stink bids in, because I'm telling you, it's like, if you want to get into, and I don't own gold basin, I'm looking at, but I don't own it, so I'm just saying that if you want to dabble in the, let's say, most high risk or most speculative parts, it's like, you have to pretty much have stink bids in, hope you get fills, because this might be one person that brought this up to 40%. You can imagine what's going to happen in this sector when there's 40 people that wants to buy some of these juniors. You can forget about the quotes you see today. It's like, oh, this is at 12 cents. I don't know. I'm gonna hold off. No panic. They haven't moved yet, etc. When they move, so obviously it's gonna be too late. That's what I'm saying. But we don't either know when it moves. It can also go down. So it's like, you should be prepared, like Rick Rule says. It's like, you got to be patient. They can go down first. But what I am saying is that it's a mirage. Some of the share prices, it's a pure mirage. They look real, like in our heads we're like, oh, I can buy an endless amount of this junior and there's no rush and all that. These prices might be gone in a day. That's what I'm saying. If you're early, you're too late. Or if you're not too early, you're too late. And take Bear Creek. It didn't take too long, or this is an even better example. If you sold the way down here or whatever, it's like in a month, it clawed back most of the entire fall. Here's like, okay, starts to get going, nobody really believes, and it's like, then it's like ramps. And it's like all of a sudden every single buy you ever did up until, I mean, it didn't take too long. What's this? January. In 4 months, it's like every single buy you did from 2015 for the last year, you were all of a sudden neutral or in fat in the green. In 1 month, every single, let's say you start buying here, whatever, looked wrong, totally wrong for a year. In 1 month, every single buy looked smart all of a sudden. And some of the, again, it's like the even lower liquidity juniors, you have no idea how quickly they can revalue. Another one, it's like even more extreme, Sanyo Gold. Just one day pop. I mean, you shouldn't make too much of it, obviously, either, because it's not like there's a ton of money. But what I am saying is like 11,000 shares traded, up 37.5%. I mean, it's from very low levels, obviously. Let's actually check. Let's check here. And I actually bought, I think, a private placement quite early on in Sanyo, maybe even pre-IPO or IPO, and it's like down, 80% something. But let's say, okay, that was 11,000 shares. 11,000 shares. 11,000 shares times 550 Canadian dollars had it up 37%. So let's say, again, it looks like in Sanyo Gold, for example, that it's in the doldrums, basically. Let's say you start buying here, it's like, oh Jesus, it's been, it's been 8 months. Let's say, average down. It's like 8 months, it's like no end in sight. Again, no shore in sight. Oh, just a disaster. And that's already from, coming off of this for performance. Let's say it's like, oh, you buy in average, whatever. It's like you look wrong on every single one, especially when it hit a low here. It's like, oh, it's just being dragged across concrete. Let's say someone wants, or some people all of a sudden decide, hey, we want to buy for 30,000 shares. Maybe it's up, 74%. And when we go from, and that would just obviously be like if we go into a real bull starter run, you have no idea how quickly you can be in profit in pretty much every single dirt cheap junior that is still going to be around for the turn. You have no idea how quickly that entire position, every single buy, let's say, can turn from a loss to a gain. And that might still just be the first wisp like this. When we go into hyper drive, it's like, I hope you get my point. It's like that's the price of being too early, and especially way too early. It's like you have to look beyond. Rick Rule says, he makes the safe, let's say, wording is like up to 5 years. And obviously he's very, very enthusiastic about that. That should give us some perspective. It's like, to him, 3 years, 2-3 years is short term. That's nothing to wait for, mean reversions to the, when, I mean, the kind of mean reversion you would expect when it hits, goes from generationally cheap levels to, it's like, these moves are so violent, brutal. Everything comes basically from at the same time, and especially from the lower levels you start off with, they tend to be even more brutal. So that's just something to keep in mind. It's like, if you're early, you're gonna look wrong. You might look wrong. You might look wrong for months or years, even. And it doesn't matter if you started buying here. if you bought high, the worst thing you can do is sell low. If Rick Rule says this is the, let's say, the cheapest, biggest opportunity in this sector in his career, that means he thinks this is the best place to make money in the future, or at least in this sector since, the last 40 years. So what better way to make back, let's say, money you lost than to be in the best place possible to make money in the future? So yeah, long rant, obviously ended up longer than I always intend. But I hope, again, as some kind of copium, it's like, I'm just saying it, it's like you have no idea. If you haven't seen a bull run in this sector, you have no idea what you're in for. You have no idea how quickly it can turn. The only thing we know, it's getting, for every day it hasn't started, we're getting one day closer. So given where we are at these levels, I will assume that every single one of these that's going to come is going to be this one. Obviously, it's like this one looks more probable to have been it than this because it's cheaper and longer in the downtrend. So by definition, it's closer. We know in hindsight this wasn't it, but now it's even, let's say it's starting off from an even cheaper level. That makes it more probable that this is as far as cheapness goes, because it's, it went from, let's say, extreme to even more extreme, and now we're at like 40 years extreme, let's say, or 30 or 20 or whatever. That means we don't know when, but we know the probabilities of the next one being the real one increases. And if that wouldn't be the real one, well, then I don't know what's happened or has happened in the world. But so we gotta assume that that this can start at any single point in time in the junior sector. If it's not starting tomorrow, it's a higher likelihood of starting the day after. You know what I mean? It's like the urgency should be going up. Even though like here, the downtrend, but the urgency should be going up. And in hindsight, yes, the cheaper you bought, the more you made. Cheaper you bought, the more you made. Cheaper you bought, the more you made. Cheaper you bought, the more you made for a time at least. And when we go again into this was I would say a fake rally, or a fake bull leg. This was more of a bull leg at least. This was certainly a bull leg. But imagine if we're in for a bull market. Again, imagine we're in for a bull market. Maybe I can. Well, I don't. Well, let's say. Let's say this is a real bull market. It's like we have no idea if we're here, down here, but you can see the percentage. We don't know. We know that every single one of these buys would end up making a extreme outperformance. Even buying here 100% in 2008, 3 years, that's still good returns. Every single buy, all the way down, just would turn out to be a very profitable buy with higher and higher and higher and higher rewards. Yet every single buy up until this place, if you bought here, 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 down here, every single one of those would be in the red. You would look massively stupid, be down a lot, minus 50% easily. Everybody would be, your neighbor would just say what a dumb mofo you are for catching a falling knife, yada yada yada. Every single buy would be in the red, deep in the red. Some buys, first buy would be down 90%, almost totally erased. Fast forward 3 years, every single buy would be in the green. Every single buy. Some buys would have been shown profits like 500%, 600%, 700%, 800%, 900%, 1000%, etc., etc. You would get the last laugh if you stayed around for the turn. if you only play this cycle point of maximum despair, point of maximum profit, okay? If you're only in this cycle from here to here, you saw one side of a cyclical sector. This is a one-way street. That's not a cycle. That's a one-way street. This is a cyclical sector. Boom, boom. And of course, again, add in dilution, and it's like you get a sense how fat this bull was here. One cycle, and it's like, let's say, call it medium term. To only stay for this or this is completely missing the point why Pierre Lassonde says it's the easiest sector in the world. If you only ever, in whatever sector, stays for this and not for what happens afterwards, you're never ever gonna make money unless you're the best stock picker in the entire world by a... Yeah, basically. It's cyclical. Cyclical means it goes up and down. Cyclical does not mean if it has gone down a long time, that means it's always going to go down. Cyclical doesn't mean that if it's gone up for a long time and up a huge amount in a long time, it's always going to go up. Just remember that. Yeah, so thanks for listening. Again, it's like Bear Creek, that's a proxy I use. I don't own it. I think I might have at least some Sanyu warrants. I might have some shares still, actually. Otherwise, I don't think I mentioned any particular company. But if I mention companies, just assume I'm biased. And some are obviously sponsors as well. Thanks for listening. Bye-bye.